All right, so this is the last part of our life insurance module. As I mentioned before, I'm not able to cover 100% of the material, but this is about 80%. And it's going to avoid you guys reading the book and basically have to studying a lot. If you understand the concept, the logic, and you do some mock tests, you should be good to go. And also we have, our sessions that we can help you. All right. So now that we talked about different types of insurances, term 100, whole life and universal life, now we want to talk about some additional benefits that we can add to our life insurance policy. These benefits, right, which we either call them riders or supplementary benefits, like we have two types of benefits, riders and supplementary benefits, because there are additional options, right? If I want to give you guys an example, it's like you go to a dealership, you go to a Toyota dealership, and then they have different types of Camrys, right? And you see that the prices are different. Why? Because they say this is a basic model, this one is a sport model, this one is like the advanced model. All three are called Toyota Camry. They look the same, but compared to each other, they have different options, right? And obviously, the one that is advanced and has the most amount of options is more expensive too, because you have to pay for those options. And another thing that's really important is that if I buy, let's say, the advanced option of Toyota Camry, and I want to sell my car in the future, I can't keep the options with me. Let's say if the option is a sunroof or the option is leather seats, okay? I can't say, okay, I'm going to sell my car, but I'm going to keep the sorry about that, keep the leather, I can't really say it. I'm going to keep the seats or I'm going to keep the sunroof. You have to sell it altogether. It's the same thing with life insurance. You can add some optional benefits on it, right? But if you cancel your policy, you're going to lose those benefits as well. And obviously, if you want to have these benefits, right, it's going to cost you more. So riders are the ones that these benefits are going to be paid upon the death of the insured. All right. So let's talk about this. What are some of the riders that we have that these are options that we can add and basically will be paid upon the death of the insured? The first one is paid up addition, just like what we heard and what we read in whole life policies. You can use your dividends either in the dividends that you get from Universal Life, right? From the mutual funds that you've invested, or the whole life policy if you get it a participating whole life. You can use it to purchase a permanent life insurance with cash value, which is going to stay inside the policy. So you're adding more life insurance to your policy, and when the insured passes away, there's going to be more death benefit for the family. Or I could simply add a term insurance to my policy. Why should I do that? Let's say if somebody has a mix of permanent and temporary needs, and I want to know what should I do here. So let's say, for instance, somebody needs $500,000 for estate taxes, funeral expenses, legacy, all of that, but also has a $300,000 mortgage that will be paid off in basically 20 years. So I'm not going to give them an $800,000 term insurance, and I'm not going to give them an $800,000 of permanent policy because none of them are actually correct, right? If I give them term policy, they might outlive that 20 years and the client still needs $500,000. If I give them a permanent policy, they have to pay more for something that they don't need because that $300,000 is only temporary. So what I'm going to do is I'm going to give, let's say, a permanent policy, whatever it's going to be, universal life, whole life, whatever, of $500,000. And then I'm going to add the term rider to it. Let's say a T20 of $300,000. So for the first 20 years, they have $800,000 of policy and insurance. And after that, it is going to be $500,000 that they need. So this is how we can do this. Third, a child coverage. So what is a child coverage? A child coverage is that you insure your children in your own policy as well. You pay an additional fee, a monthly premium, and you're going to have your kids insured. Usually it's with a much more lower death benefit, like maybe 30, 40, $50,000. And if the child dies, so this is not for their education in the future. Sometimes I see, students, they think that child coverage is like something that we're doing investments for our children. No, it's actually completely the opposite. It's about if they die, the policy owner will get some death benefit. So you can insure your children before they turn 16, right? So that you can insure them when they're 5, 4, 3, 2, whatever, up to age 16. And it's going to stay, this coverage is going to stay until age 21. After 21, it's going to be canceled. So if that child passes away, the policy owner is going to get some insurance, right? And some death benefits. Now, keep in mind, when I'm saying that there's no limit on how many kids, what I mean is this. Let's say there's a husband and wife, and then they decide to add a child coverage, and they only have one child, right? Let's say that one child is going to cost them. So one child, it might cost them $10 a month. If they had two children, maybe it's going to be $20 a month. But let's say if they only had one child, but in the future they're going to have a new baby, then they don't need to tell the insurance company that we have a new baby. The new baby is going to be automatically covered on the same coverage. Let's say if both children die, right? The insurance company is going to give two children coverages, okay, even though that they were only paying $10 a month, and even though that they didn't even tell the insurance company that we have a new child. Just keep in mind that children and babies, they're not insured for the first 14 days that they are born, right? So if the new baby dies like 5 days after it was born, obviously there's no coverage. But if it was 2 months later, there is that coverage, even though that they didn't tell the insurance company that they have a newborn baby. So there's no increase in premium, and your children are all going to be covered under that coverage. So this is really important because questions will come for it. We have something called a family coverage as well, which is basically like a child coverage, but you add your spouse too, and the spouse is going to be insured up to age 65, right? So that is another thing. Again, if the policy owner cancels their policy, there's no child coverage or family coverage left. It's all going to be canceled. We have accidental death, which means that if the insured dies due to an accident, right, there's going to be extra amount of death benefit. It might be a percentage. Let's say they say it's 50% of your death benefit will be added to it. So let's say if client had $500,000 of insurance with a 50% accidental death benefit, that means that if they die based on accident, they're going to get 750,000, right? So that's what's really important. Or it could be just a specific amount, like $200,000, let's say, right? And we have guaranteed insurability benefit. I would say this is one of the most important ones in terms of your exam. So a GIB rider, right, basically means that you can add to your coverage in the future without any medical underwriting. So let's say right now I only have $200,000 of coverage, right? And in the future, I want to add another $100,000. So I want to have $300,000. Obviously, I have to do medical underwriting for this $100,000. But because I had a GIB rider, there's going to be no medical or proof of insurability, right? But the new price, this $100,000, is going to be based on my new age. So let's say if I was 20 years old when I got this policy, and at age 30, I decided to add this $100,000, the cost of insurance for this $100,000 is going to be based on my new age. It's going to be based on age 30, not age 20. All right. So that's the important part that you guys have to keep in mind. So these are the riders. As you can see, all of these, they will only be paid when someone dies. All right. But when we talk about supplementary benefits, it's about benefits that will be paid to the insured and before death. So what are they? And by the way, before going into it, eventually we call all of them riders, right? In common, even in the questions, you will rarely see we call it supplementary benefits. We just call all of them rider. But remember, if in the questions it comes up that which one is, what is this? Is it a rider or supplementary benefit? You have to make sure that you're answering the right and choosing the right answer, basically. So for supplementary benefits, one of them is called terminal illness. We talked a little bit about it in the previous video as well. So if we have a terminal illness benefit, means that if the insured is diagnosed with less than 12 months to live, they can take advanced payout of their death benefit themselves. It could be 10%, 20%, 50%, 100%. Some insurance companies, they pay 100% of the death benefit if you are terminally ill, right? So see, this benefit is paid before death. All right, this is how it works. Next one is called critical illness. So you can add a critical illness coverage to your life insurance that if you are diagnosed with a major disease, usually it's cancer, coronary bypass, heart attack, stroke, but they could be up to 25 different diseases. All of these, it could be payable. So it's an extra insurance of critical illness on your life insurance policy. Again, if you cancel your insurance policy, your life insurance, the critical illness insurance is going to be gone too. So again, this is a benefit that's going to be paid before death. Waiver of premium. This one means that if the insured becomes totally disabled, they don't need to pay the premiums anymore. So you basically get this additional benefit and you pay for it, right? That if in case you get permanently or basically get permanently totally disabled, you don't need to pay your premiums anymore, right? And that's a really good sign. This is when the insured and policy owner are the same people. So policy owner is the same as the insured. But what if the policy owner is not the insured? Let's say a husband bought insurance for on the life of his wife or on the life of their children. Then it's called parent or payer waiver of premium. All right. So in this one, if the policyholder becomes disabled or dies. So let's say the father bought, life insurance for the children. Okay, the father dies, but the insured is still alive, so there's not going to be any death benefit paid, right? The policy is still in force. But because the payer or the parent died, there's going to be no more premiums to pay, right? The premiums are waived. Or let's say if that father becomes disabled, again, doesn't need to pay. So that's a really good benefit as well. And the last one is called accidental dismemberment. So this one is that if the insured becomes disabled, there's going to be additional payment paid to the insured. We also have an insurance called AD&D, all right? I'm just going to write it down here. AD&D. It's accidental death and dismemberment. So it only covers you if you die uh, by an accident or if you become disabled because of an accident. Um, that is the only way that they're going to pay. It's not going to pay you on normal death, right? So that is the riders and the supplementary benefits. Let's actually go into a couple of questions. So this one, it's saying that Angela is a policyholder and the life insured of a life insurance policy with several supplementary benefits. Which of the following supplementary benefits, if used, will reduce the policy's death benefit paid upon Angela's death? So among all these, let's actually go back. Among all these supplementary benefits that we just reviewed, there is one of them that will reduce the death benefit, and that is the terminal illness one. All right, because it's going to be an advanced payout of the death benefit. The critical illness is additional. Waiver of premium. Well, there's no reduction in the death benefit. Accidental dismemberment is again additional benefit, right? So even in these riders, again, none of them are going to reduce the coverage, right? It's only terminal illness, or they call it living benefit as well sometimes. So it's terminal illness. In this one, Damien purchased the $1 million whole life insurance policy with a guaranteed insurability benefit rider. So in the future, they can add more coverage without any medical or proof of insurability. The GIB rider allows a 10% increase of the face amount each time the option is exercised. So every time that if they want to use, basically this GIB rider, they can increase it by 10% only for the next 20 years. So after 20 years, they can't do it anymore. So until, um, 20 years, they can use this at the policy anniversary for a cumulative increase of $500,000. So it can't go more than $500,000 as well. So if they go 10%, 10%, 10%, basically means that they can exercise this GIB rider 5 times in the next 20 years to add $500,000 because 10% of 1 million is $100,000. So they can do this 5 times. Now identify the correct statement about using the GIB rider. Let's go with the first one. Damien will be able to increase the face amount using the GIB rider only after providing proof of insurability, which this is wrong because as we mentioned, the GIB rider is actually avoiding that proof of insurability. Damien will be able to increase his policy face amount in the future using the GIB rider, even if his health declines. This sounds about right because obviously when we don't need any proof of insurability, no medical underwriting, that means that even if Damien is diagnosed with cancer and wants to add 10% to the death benefit, he can do that. The premiums for the additional insurance will be based on Damien's original age at the time of policy purchase, which I mentioned that is wrong. It's going to be based on the attained age. We call it attained age. All right, so not the original age. And Damien will be able to increase coverage to a maximum of $500,000 without a corresponding increase in premiums. That is not true as well. Your premiums will increase, and it's going to be based on your attained age. So the correct answer is B, that even if the health declines, because there's no health or medical insurability required, you will be able to use it. All right, let's talk a little bit about group insurance. We're almost there to finish this module. Group insurance. What is a group insurance? It's some benefits that basically, your employer where you're working will provide to you, right? And in this case, it could be some, health and dental benefits. It could be critical illness insurance. It could be disability insurance, and also it could be life insurance as well. We're going to talk more about the other parts, aside from life insurance in the next module in accident sickness. But specifically, we're going to talk about the life insurance parts in this section. So in a group insurance, the policy owner is always the employer, all right? Or they call them the plan sponsor as well. So the policy owner is the employer. It's your boss. It's the company that you work with. The insurability needs no evidence. What do we mean by that? There's going to be no medical tests, no proof of insurability, nothing, right? If you are hired in a company, usually you have to pass the probation period, and then you're going to be enrolled with these group insurances. So it doesn't matter if you're disabled, if you have heart conditions, if you have cancer, whatever, you are still going to be insured, all right? Because you're working for that company. And the premiums are based on the makeup of the group. So obviously based on the nature of that business, how many clients, how many employees they have, how many people are getting insured, stuff like that. The premiums are going to be calculated, all right? And usually the premiums are paid by the employer as well. Usually, not always. And the premiums are guaranteed for only 1 year. So every year, the insurance company is going to reassess everything with the basically company or the corporation, and they're going to give new premiums. And the coverage only is intact until you are still an employee or age 65. So if you retire, if you get laid off, if you resign, any of these happen, your coverage is canceled. You do have 30 days to convert it to an individual policy. All right. You have 30 days after you leave that company to convert it to an individual policy, but it's going to be super expensive. Well, super is exaggerating, but it's going to be really expensive. So let's say if somebody is 40 years old, right, and had $100,000 of group coverage, life insurance, is now resigning or whatever happening, wants to convert this, it's going to be more expensive than if they just apply for an individual policy. Why? Because this conversion is again with no medical. So there's going to be no medical. The company actually never, the insurance company never did any medical underwriting on this person because when they were hired, there was no evidence required. And now they're converting it again to an individual policy, which needs no medical underwriting as well. So again, it's going to be, um, you know, completely risky. So it's going to be really expensive. So only if this 40-year-old has major health issues, or probably is going to even get a worse rate if they apply individually, then we recommend to convert your coverage, your group coverage to an individual policy. So other than that, you never convert a group policy to an individual policy when you're actually leaving the company. Only if you know that the client has, or basically the insured has medical conditions and will not be approved with a better rate or will not be approved at all. That is the only time in the questions that you are going to answer, yes, let's convert it. So that's really important. Let's talk about taxes. So if employer pays the premiums, obviously who's getting the benefits? The beneficiary is who? Is whoever the employee chooses. So employee chooses the beneficiary. It could be their family members, whoever they want, right? So if the employer is paying the premium, it's an expense. And they're not getting any benefit out of it because the death benefit is not going to go back to the company. It's going to go to the employee's, family or whoever. So it's a taxable benefit for um, employee. This is basically disregard this part because this is for accidental death and critical illness. But for the basically this part is important. I don't want you guys to right now focus on this. That's for health and dental and stuff like that. But for the life insurance part, it's a tax deductible for the employer, and also it is a tax-free death benefit. So life insurance is always going to be tax-free. All right. Regardless of who pays the premium, it's the employer or the employee, or if it's a contribution of both, the death benefit is always tax-free. But because the employer is not gaining anything out of this, it's simply an expense for them. So it's a tax deductible, for expense for the employer. All right. But if the employee is paying the premium, again, let's disregard this first part, which is about group benefits, but um, it is not tax deductible for employee, and employer as well, right? And employer. Why? Because, well, the employer didn't pay for it, so there's nothing to deduct. And employees are not businesses, so they can't deduct any expense. All right. So if the employee is paying for the premiums, no one can actually use it as tax deductible. But the death benefit again is going to be tax free, which is really important. All right. So regardless of who pays the premium, death benefit is tax free. If employer pays a premium, it's tax deductible for the employer. If the employee pays a premium, it is not tax deductible for anyone. All right. But that was for the employees. Now, let's go and talk about business. All right. So before we go into the business insurance part, it's really important that we understand what type of businesses we have. So the first type of business that we have is sole. Do not want me to pronounce the second part. I've tried my best. Proprietorship, whatever it is. Anyway, I don't know why they make it so difficult. But what it means is that it's basically a self-employment business, and your business is not a different entity. Your assets, your personal assets and your business assets are the same. Okay. And then we have partnership, which is just like sole, but between a couple people. So again, personal assets and business assets for each of the shareholders, it's going to be the same. All right. But then we have corporation, which corporations are a separate entity, right? And it's going to be public. It could be a public corporation, like the ones that you see in the stock market, which you can, buy and sell the shares, right? Like Apple, Amazon, Tesla, all of these are public corporations. But then we have private corporations as well. And specifically, we have the CCPC. What does that mean? Canadian Controlled Private Corporation. If this is a Canadian company, which means that the shareholders are Canadian or are either a permanent resident or citizen, um, they will have something called a LCGE. So what that means is that obviously there's shares of the corporation, right? And again, this is private, so it's not accessible to everyone to buy those shares. These shares grow, and just like any stock, these shares are going to be subject to capital gain as well, right? So it has a 50% tax exempt and all of that. But because it's a CCPC, you have something called an LCGE as well, a lifetime capital gain exemption. What this does is basically it's telling you whatever capital gain you had. So let's say if the shares of the shareholder increases by $3 million. Okay, this is now what is their shares worth. Every year the government announces how much it is. So recently it's about 1.3 million. So 1.3 million of it is going to be deducted, right? It's going to be tax free. So there's going to be how much left? 1.7 million. And out of this 1.7 million, now 50% of it is tax exempt because it's capital gain. So you have to pay tax on how much? On 355, $850,000, right? So even though this was the gain, let's say the total gain of their shares was $3 million, you deduct the LCG from it, the capital gains exemption, which means that you don't need to pay tax on it. And then whatever is left, because it's capital gain again, you will do a 50% tax exempt, you'll reduce another 50%. Now you have to pay tax on $850,000 of the gain. So that's a huge help to private corporations, CCPC ones, that you can use that LCG as well to reduce your taxes. Now, let's say we have this situation that there's a couple of partners, right, or shareholders, and they are kind of concerned about what? About what if one of them dies? Who's going to take over, right? Who's going to take over of those shares? And usually it's because they don't want their family to interfere into the business after their death, right? Um, so we have something called a buy-sell agreement. And there's two major ones. You can study the book as well. It kind of gives a more um, context to it. But for you guys to understand, this is really important. There's one that is called a crisscross arrangement, which could be used for the partnerships or for CCPCs. All right. Now, how does this work? Let's say if there's shareholder A, right, that has 100 shares, and person B that has 200 shares, and they want to make sure that if one of them dies, okay, the other one is going to buy the other's shares. So this is what they call the buy-sell agreement. They're gonna have an agreement that if A dies, B is going to buy those 100 shares. If B dies, A is going to buy those 200 shares. All right. And this is an agreement that cannot be voided. So when they pass, B will buy the shares and nobody can um, dispute it. So for funding the money for these shares, they're going to purchase life insurance on each other. That's where the crisscross comes in place. So A is going to insure B and B is going to insure A. So obviously, because A has less shares, B is going to buy less insurance and also going to pay less premiums. And because A is insuring 200 shares, right? Because if B dies, they have to pay 200 shares to buy it. Then A is going to buy more insurance and is going to pay more premiums. This is what we call a crisscross. All right. So A insures B and B insures A. How it works is that if B dies, A is going to get the money, and then with that money, they're going to buy the shares. Okay, so the insurance company is going to pay the money to A. They're not going to pay the money to B's estate to basically pay for the shares. That is A's responsibility to do that, right? Because these shares are going to go into the estate, of the deceased, right? And then based on the buy-sell agreement that they have, and with the death benefit that A received from B's death, they're going to pay the estate and they're going to get the shares. That's how it's going to work. All right. So now there's another one that we can do, which is only for CCPCs. All right. Which is called share redemption. In this case, it's not the shareholders that are insuring each other because over here, A is the policy owner and B is the insured, and then A is the beneficiary, or vice versa, right? But over here in share redemption, the policy owner is going to be the company, and the company is going to insure A and B. So if A dies, what happens? Policy owner was company, the beneficiary is the company as well. So the money, the death benefit, is going to go to the corporation. There's another difference as well. In crisscross, if A died, now B has 300 shares, right? Because they're going to buy the 100 shares that A had, or the 200 shares that they had themselves, it's going to be 300. But in share redemption, because it's the company buying these shares, B's shares is still going to say 200. This is going to be 100 shares for the company, and then the company can sell those shares. And as you know, because it's a CCPC, not everyone can buy those shares. The board of directors have to accept and approve who is going to be the new buyer. It could be one of the shareholders, it could be somebody from outside. But what we know for sure is that A's family is not going to inherit um, the shares, right? The shares are bought by the company. All right. So this is something that's really important. So the company insures the shareholders, and whoever dies, the company takes the shares, and the deceased's family receives the death benefit. So these shares will stay the same unless then they buy from the company. I hope that made sense to you guys. Crisscross and share redemption. Um, let's go into a couple of questions and leave it as there. Actually, these questions, I think it's mostly going to be a review of the whole life insurance, but this one, let's talk about it. Shilpa is the sole owner, let's say, of a fashion boutique that is managed successfully by her key employee. Oh, let's talk about key employee. I always forget to add this part. What is a key employee insurance? Really important. So a key employee insurance is your most profitable, sorry, employee. So you might have multiple employees, but one of them is bringing the most revenue. It could be your marketer, it could be your, um, I know, salesperson, it could be your accountant, it could be whoever you identify as the most profitable employee. That is going to be your key employee. And if that key employee dies, there's going to be a huge effect on the company's sales and revenues, right? So the company can do what? There could be a policy owner that is a company, and then the insured is going to be the employee, the key employee, and then the beneficiary is again the company. And the company is going to use that money to cover the losses until they can find a new employee that is going to give the same, basically, quality and revenue, right? So this is what we call a key employee insurance. I had to explain this. All right. So is managed successfully by her key employee Ria, who is a talented fashion designer. Because the client base is growing exponentially, Shilpa obtained a demand loan of $200,000 for business purposes. Shilpa is married to Reynold, who helps her with her business. If Shilpa dies, the ownership of the business will roll over to Reynold. Which of the following issues could be addressed with life insurance and should be discussed with Shilpa? So, first of all, there's no issue that she needs. First of all, she doesn't even have a partner in this business. It's a sole business, right? So there's no crisscross or share redemption or anything like that. Also, she has no problem with her husband taking over the business after she dies. There is a key employee, Ria, and also there's a $200,000 loan, right? Um, let's see what the risks are here. What are the issues? So I guess one of the issues is that if the key employee dies, it's going to be a loss of skills. And the other one is the debt, the loan that they have, right? So for that case, I would say option A is the right choice. We don't have any problems with family interference. As I mentioned, it's completely evident that Reynolds is helping and also will take over the company. Um, and we haven't talked about any capital gains tax in this question, right? So the only two issues that we can see, the concerns that we can see, is a key employee and also the $200,000 loan, which is not protected. Alden is a travel blogger. Oh, I think this question was answered in the first basically video, so I'm not going to repeat it. All right, so we covered the riders. We covered the supplementary benefits, group insurance, business insurances, key employee as well. And that's about it. That this is 80% of life insurance. You guys are ready to actually start doing some mock tests. And if there's any questions, you can always reach out to me and I'll be more than happy to help. Um, yeah, I hope you guys have a good day and thank you for listening.